Alfonso Cahero, A Journey into Finance History, Chapter 54, Global Financial Crisis, 2008. In the late 1990s and early 2000s, the world basked in the glow of economic prosperity. Countries were interconnected like never before, and financial markets boomed. The streets of New York, London, and Tokyo thrived with the buzz of financial activity. Major banks and investment firms touted innovative financial products, heralding a new era of growth and opportunity. It was a time of optimism, where the sky seemed the only limit. In the heart of this booming economy was John Hartman, a young financial analyst at one of Wall Street's top investment banks, Hawthorne & Co. John had always been fascinated by numbers and the intricate workings of the financial world. He had worked tirelessly to earn his place in the bustling, high-stakes environment of Wall Street. The rush of trading floors, the constant ringing of phones, and the ceaseless clatter of keyboards was his symphony. John lived in a small, modern apartment in Manhattan. His days were long, starting before dawn and often ending well after the sun had set. Yet, the relentless pace didn't bother him. It invigorated him. The thrill of sealing a deal, the satisfaction of making a successful prediction about the market's movements, was intoxicating. He was part of a generation of financial wizards who seemed to have unlocked the secrets to endless wealth. At the core of this booming financial world were complex financial instruments called derivatives and mortgage-backed securities. These products were touted as the future of finance, promising high returns with seemingly little risk. Banks, hedge funds, and other financial institutions eagerly dived into this ocean of opportunity, buoyed by the belief that real estate prices would continue to rise indefinitely. Hawthorne & Co., where John worked, was one of the leading players in the mortgage-backed securities market. They bought thousands of mortgages, bundled them together, and sold shares of these bundles to investors around the world. The housing market seemed invincible, and everyone wanted a piece of the action. John and his colleagues worked feverishly, analyzing data, structuring deals, and securing investments. Outside the gleaming skyscrapers of Wall Street, the housing market was booming. Ordinary people, from young professionals to retirees, were buying homes, often financed by adjustable-rate mortgages that offered low initial rates. For many, it was a dream come true. They could finally own a piece of the American dream. Real estate agents, mortgage brokers, and construction companies flourished in this golden age of property. Yet, beneath the surface of this prosperity, cracks were beginning to form. John, like many of his colleagues, had begun to notice anomalies in the data. Mortgage defaults were rising, albeit slowly. Some of the loans bundled into the securities they sold were showing signs of weakness. But these warning signs were often dismissed as temporary setbacks, mere blips on the radar of progress. At company meetings, executives reassured the team that the housing market was strong and that any issues were isolated. The demand for mortgage-backed securities remained high, and the profits were astronomical. As bonuses rolled in, John and his colleagues felt invincible. The mantra of "too big to fail" echoed in the halls of Hawthorne & Co. John's evenings often ended at upscale bars or exclusive clubs, where he and his co-workers celebrated their success. They discussed market trends, speculated on future deals, and reveled in their seemingly limitless potential. The financial world, with all its complexity and opportunity, was their playground. However, John couldn't shake a growing sense of unease. He began to dig deeper into the numbers, scrutinizing the data with a fine-tooth comb. What he found disturbed him. The adjustable-rate mortgages that had fueled the housing boom were beginning to reset, causing monthly payments to rise. Homeowners who had stretched their finances to buy properties were now struggling to make ends meet. Foreclosures were increasing, and the domino effect was starting to take hold. John confided his concerns to a close friend and colleague, Lisa, who worked in the risk management department. Lisa had been monitoring the situation closely and shared his worries. Together, they began to piece together the bigger picture. The entire financial system was intricately linked, and the growing instability in the housing market could trigger a much larger crisis. One late night, after poring over endless spreadsheets and reports, John and Lisa realized the magnitude of what they were facing. The financial products they had so eagerly promoted were built on a foundation of sand. If the housing market collapsed, the ripple effects would be devastating, not just for their firm but for the entire global economy. As they sat in the dimly lit office, the weight of their discovery settled over them. They knew they had to act, but the question was how. The world was teetering on the edge of a precipice, and the choices they made in the coming days and weeks would be critical. The financial storm that was brewing had the potential to reshape the world as they knew it, and they were at the heart of it all. The summer of 2007 was unseasonably warm in New York City, but the atmosphere at Hawthorne & Co. was growing decidedly chilly. John and Lisa's late-night revelations had stirred a sense of urgency and dread within them. They knew they had to act fast, but the path forward was fraught with uncertainty and risk. The financial world was a vast, interconnected web, and pulling one thread could unravel the entire system. John decided to approach his mentor, Robert Thompson, a senior executive at the firm. Robert was a seasoned veteran of Wall Street, known for his sharp mind and steady hand in turbulent times. John respected him immensely and hoped he would see the gravity of the situation. "Robert, can I have a word?" John asked, entering Robert's spacious corner office with its panoramic views of the city. "Of course, John, what's on your mind?" Robert replied, motioning for him to sit. John took a deep breath and launched into his findings. He explained the rising mortgage defaults, the resetting adjustable rate mortgages, and the potential for a cascading crisis in the financial system. Robert listened intently, his expression growing more serious with each passing minute. "John, these are serious concerns," Robert said finally. "But we need more than just data anomalies to take action. The market has always had its ups and downs. We need concrete evidence of a systemic issue before we can sound the alarm." Undeterred, John continued his investigation, enlisting Lisa's help to gather more data and evidence. They worked tirelessly, often through the night, to compile a comprehensive report. Their findings were alarming. The subprime mortgage market was teetering on the brink of collapse, and the ripple effects could devastate financial institutions worldwide. With their report in hand, John and Lisa requested a meeting with the firm's executive committee. The stakes were high, and they knew they needed to present a compelling case to persuade the decision-makers. The meeting took place in a sleek, modern conference room on the top floor of Hawthorne & Co.'s headquarters. The city's skyline stretched out in the distance, a testament to the financial empire they were trying to protect. John and Lisa stood before the committee, a group of seasoned executives with decades of experience between them. John began the presentation, outlining their findings with precision and clarity. He highlighted the data trends, the rising defaults, and the potential for a broader financial collapse. Lisa followed, detailing the interconnected nature of the financial products and the systemic risks involved. As they spoke, the faces of the executives grew increasingly grave. They knew the implications of what John and Lisa were presenting. If they were correct, the entire financial system was in jeopardy. "Thank you, John and Lisa," Robert said, breaking the silence that had settled over the room. "We need to take this seriously, but we also need to act prudently. Our first step should be to reduce our exposure to these risky assets. We can't afford to be caught off guard if the market turns." The decision was made to quietly begin selling off the riskiest mortgage-backed securities in their portfolio. It was a delicate balancing act. They needed to offload these assets without causing a panic in the market. John and Lisa were tasked with overseeing the operation, a daunting responsibility, but one they accepted with determination. As they worked to execute their plan, the broader financial world remained largely oblivious to the brewing storm. News reports still focused on the robust economy and soaring housing market. But behind the scenes, signs of strain were becoming more apparent. Other firms were also starting to notice the cracks in the foundation and were taking similar steps to mitigate their risks. By early 2008, the financial landscape was shifting. Rumors of trouble in the mortgage market were circulating, and a few smaller firms had already gone under. The larger institutions, however, continued to project confidence. The prevailing belief was that the market would stabilize and that any downturn would be temporary. John, Lisa, and their colleagues at Hawthorne & Co. watched these developments with a mix of anxiety and determination. They had done what they could to prepare, but the full extent of the crisis was still unknown. The interconnected nature of the global financial system meant that a collapse in one area could trigger a chain reaction, affecting markets and economies around the world.